I'm Rich Goold. I have two roles. I head up the tech sector for Law globally. I'm a venture capital and M&A partner. I also head up all of our service lines in the UK for fast growth, and we work with about 130 startup and scale-ups now, typically valued between about 5 million and 500 million. I'm here with Matt Milligan. I'm going to talk to you today about fundraising with a European perspective and also the path through to exit. Matt's here to introduce what we do with our startup network.
Yeah, thanks, Rich. Hi, everyone. Yeah, so as Rich said, Matt Milligan, Rich and I have been working quite closely together for almost 2 years now. But leading the startup network in the UK now for the best part of 2.5 years. We've engaged a lot of EY people across our UK business and essentially given them a platform to go out to market and build relationships with early stage founders. So if anyone in the audience is interested about how we can organically grow startup ecosystems, I'm really happy to speak to you. Rich?
Great, thanks, Matt. So, a little bit about us. So we tend to have a very transactional focus in what we do with fast growth. We essentially have an application-only process where we introduce our services, which tend to be a very broad range of services for companies, from accounting and tax and IPO and exit readiness, all the way through to new services like law. But in the UK, at least, the vast majority of companies end up getting sold for under 500 million. So whilst we're very happy to support companies through to IPO, the vast majority of our energies go into helping them raise larger rounds of money and helping them through to private M&A events. And just listed here are some of the more recent transactions where we've raised money, quite significant amounts of money sometimes, or sold companies, either with our corporate finance colleagues in law and tax, or one of those above. And for the last couple of years, we've worked on, I think, the 5 largest VC deals in the UK, somewhere between 100 million and 500 million in some cases. The EY Fast Growth Platform is supposed to be really a combination of strategic support as well as those day-to-day services. Whilst all companies need those day-to-day services, we think that the real value that EY brings is by providing mentorship, coaching, and introductions as well. So we have a combination of our junior people as well as technology to provide the day-to-day services. But then we make sure through Entrepreneur of the Year, as well as our partners, we get the most senior people within EY and within the broader EY family to engage with these startups to really help them accelerate their growth. It's a long range of services, the things that we do, but essentially we bucket them into 3 areas: startup, growth, and go global. And they do what they say on the tin, really. Startup is very much a checklist of things. How do you protect your IP? How do you think about tax? How do you think about your accounting and bookkeeping needs? Growth becomes a bit more sophisticated. We discount our fees, but we make sure that the more sophisticated advisory and corporate advisory services get brought to these companies in a really cost-effective way. And at the end, go global. Well, again, that does what it says on the tin. We help companies go within the EY network and beyond, anywhere they want in the world. So what do we see? I mean, particularly with the transactional lens that I focused on today, it's a really healthy landscape. We see Europe as being really one of the most vibrant VC scenes in the world right now, and that has fundamentally changed. On the left here, we see that actually the amount of value continues to go up every year. So those are the larger lines. The volume is beginning to dip off, but that means really there's a flight to quality. So larger rounds are going in at a late stage. The graph on the right-hand side of the screen shows this, that some of the earlier stages are going down in volume, but large amounts of capital are now being deployed in late-stage venture across Europe. And this is really a record-breaking set of numbers. In total, over 5 years, across Europe, the whole scene, the VC scene, has grown by 5 times. There's a report that SLUSH been released today with Atomico that back up this data that shows that over 5 years, the numbers have gone up 5 times, and actually it looks as though $23 million will be invested in, $23 billion will be invested in Europe during the course of this financial year. Why? Well, there's a huge amount of tech now coming through. You see here software, IT hardware, devices, services, farmers included, commercial services, media, energy. But the real reason is, whilst there's an increasing diversity of tech, the most large sources of capital in the world are drifting towards the very capital efficient sources of companies, which tends to be software. You can scale software companies faster than hardware companies, and the companies, the investors that really like those sources of money, that have made money in the States, are now drifting over, either directly investing in Europe, or in many cases, they are actually sourcing their deal flow indirectly through various new VC funds that are being created. In last year, and so in 2017, there were 80 new seed funds created in the UK alone. So we're seeing an explosion of the routes through to market. And why? Well, the VC returns continue to go up. We've had a blockbuster year of exits. And to answer Matty's question, then yes, absolutely. I view the IPO route as an entirely valid route through to exit. It's absolutely fantastic. Last year, I think we saw more tech IPOs in Europe, but generally those aren't the really big blockbusters. If you look at the big blockbusters, the Funding Circles, the Farfetches, the Spotifys of the world, those are 3 of the 10 largest IPOs in the world, and they all went to the US to go and launch their IPOs. But nonetheless, that belies in many ways the larger trend, which is in Europe, the sale for sub $1 billion to generally international companies, which is just sucking up a huge volume. And it's not sucking up a huge volume of companies in a particularly negative way. When you see the wall of IPOs and the wall of M&A trend converging, generally that's the beginning of a mature ecosystem. And we've seen that in places like New York, in the States, where Silicon Valley, the VCs started to move across the East Coast, and then it's the beginning of a vibrant ecosystem that will begin to seed itself. And we're now seeing that throughout the whole of Europe. Those 80 seed funds that I mentioned, many of those are seeded by exited entrepreneurs that have come out of the ecosystem. I'm going to talk a little bit about some of the deep research that we've now done around enterprise software. So first of all, how do you build a premium valuation? Then secondly, what are the themes to building to one of the most successful exits? I know that many of the startups we talk to aren't just enterprise software, but this is, in a short presentation, just a brief overview of the sort of areas that we look at with companies when we do the same sort of analysis with all the other various different verticals. So this is a framework for the sort of enterprise software which is generally the most prolific. When I said 40% of the investment in Europe has been software companies, those are generally enterprise software companies. And this is a chart that shows the forward revenue multiples, pretty racy multiples really. These companies are being valued somewhere between 4 times their forward-looking revenue and 16 times their forward-looking revenue. And what we see is successful SaaS companies can either deliver really high growth or they can deliver high margins. The public markets and the VCs will accept a trade-off between the two. I'll talk to you in a little minute about what sort of level of trade-off they accept, but you can do one or either. So one of the things that we spend a lot of time with our companies talking about is the trade-off. How fast can you grow? And I always think a really good rule of thumb is a third. If you're taking on an extra 33% of human capital in any given year, you're probably about the limits of which you can ingest people and onboard them. If you go faster than that, you're quite likely to have significant problems. The VCs, particularly the really successful US VCs, talk about the rule of 40. So the rule of 40 is all about this mix of growth and margin. If you add up your margin percentage and your growth margin, then really being over 40% is the key. Only 20% of the most successful enterprise software companies do this. So if you're growing at 40% a year, you can afford to have 0 or maybe even negative margin. And if you're really profitable, you can afford to go flat. The mix is different. And how you balance this, how you think about it, how you think about the controls in order to make sure that the mix hits your runway is quite difficult. Often the companies that grow really fast don't have the controls in place to manage this mix. And this is the sort of thing that we really roll up our sleeves and help companies with. And the last key trend, I guess, is around customer acquisition costs. You see here, the green dots tend to be companies that have a really low cost of acquiring new business. The red dots are companies where it takes a lot of time and energy to take on customers. And you see that the higher up, then they're all really green dots. And this is a growth trend. So at the top, you see 200 plus growth. So the companies that really have low cost to acquire new customers tend to have the hyperscale that VCs are looking for. And as you think about building an enterprise software company, these are the key metrics. I'm not going to go through all of them now, but it's a fairly complex set of metrics. And again, it goes back to controls. How much time and energy does an entrepreneur have to think about not just which are the key KPIs, but measuring them and putting them into a dashboard and then feeding that back to all of the stakeholders? Again, it's another key part of what we do with these businesses. Exiteering. So a key piece of work that we did in the course of the last 2 years as we really began to scale up our offering in the UK was something we call exiteering. We worked with one of the leading VCs in Europe, a business called Notion Capital, to go around and interview 20 of the most successful entrepreneurs in Europe. And we asked them, what would they do again? What would they do differently? What were the key themes to make them successful? And these were generally 100 million to 500 million type outcomes, the most typical sort of successful exit. And it was amazing, actually, that the themes were striking. So they all solved a massive problem. They all solved really big problems, and these are enterprise customers, pain points that were common between different verticals within industry, so that you could prove that you could successfully address a pain point, and then you could begin to move across to different industry verticals, and often have the same strategy for moving across geographies as well. But the geography piece was really key. The next 2 points are linked. So building an extraordinary team was an absolute must for every single one of these companies, but how that team expanded across borders, in particular to the US, really, really hard thing to do. Most companies get it wrong, but every single one of these 20 companies had all had a really successful plan. And that wasn't just about finding the market. A big part of it was having a brand that had been known to the ultimate acquirer of these businesses. Still, the vast majority of European tech companies get acquired by the US. That's a trend that will change, but having a brand that's at least known to have some traction in the US and to have some sort of brand value in the US, that was an absolute must, really. And then how those companies managed the buyer universe. Well, part of that was going to the US. Part of it was how they engaged with their own advisors. Getting a suite of advisors, whether those are your non-execs or our team or other teams like us, that was a really key part to how these really successful entrepreneurs were smart about building the value in their business. And this is a boring point, but every single one of them said the sale process, whether this was an IPO or an exit, the administrative burden was far more significant and the drain on management was far more significant than any of them anticipated. So that's something, again, that we can help with. And it starts 3, 4, 5 years out from the ultimate exit, which is why we take on companies from seed, series stage onwards, because it's not just about the 6-month run into the exit. Really, it's about having a sensible plan with a sensible team, with a data room that's built up, with financials that you can underpin the business with confidence and not just go straight into a sale process, but know all the way through it when you're going to have 50, 60, 80 people from the acquiring business pouring over your business, there won't be a big issue that's caught up at the end. And you typically find that those issues are either intellectual property, tax related, or just confidence in your financials. All of those things are addressable, but you have to address them early. Last piece, each year for the last couple of years, we've done a series of interviews with a wide set of fast growth entrepreneurs in the UK. We'd like to expand this out beyond the UK now, but we wanted to see the trends. What are entrepreneurs thinking? What are they feeling? What are they worrying about? So each time we've interviewed about 400 or so entrepreneurs of fast growth companies. And last year, fundraising was a trend, and I'll touch on the trends that have come out of fundraising and exit in a moment. But the biggest trend that has changed this year is that talent has become the number one topic for all of these entrepreneurs. How, in a scaling environment, do they get the best talent? How do they attract it? How do they reward it? And then how do they keep it? That's become a really key issue. In the UK, Brexit hasn't particularly helped that, but across the whole of Europe, then the issue is there is more opportunity for these amazing people that are coming through than they can ever see before. And they can go to a company, stay there for 2 or 3 years, move on, get equity, move on again. And these are things that have happened in the US for a long time, but we're now seeing people move around rapidly. An interesting stat, though, is that we now see in Europe more developers than in the whole of the US. So the talent pool continues to grow, and I think our job is making sure that the companies that we work with have the tools and techniques to really embrace the new way of working with people, whether it's short-term thinking or gig economy thinking, for example. And on the fundraising environment, well, the vast majority of companies think that they're going to raise money in the next 12 months. You can see here 66% of the 380 people interviewed this year think that they're going to raise money in that period. And for the most part, so almost 50% of them were looking at the 1 to 5 million range. So we're beginning to see companies really scaling up, but it's still quite an early stage ecosystem if the majority of people are raising that sort of money. If you look on the right-hand side, then these companies are generally thinking that they will sell to an international corporate. Broadly, that's because they think that they'll be able to scale faster under the wings of an international corporate that will give them the extra capital and the distribution that they need for their business. And when they think about the fundraising process or a transaction generally, these themes are the same. The number one issue for them is the distraction of the whole process, is a drain on management time. Finding suitable investors has become less of an issue, but continues to be a big drain. And then agreeing terms and managing the investor process also, significant issues. So what we've been trying to do is build technology and build our offering to address those pain points so that we can take as much of the pain, whether it's administrative or strategic, away from the entrepreneurs so they can focus on what they really want, which is generally building an amazing business, building the product, and then building the sales pipeline around that. So that's it for the fast growth, fundraising, and exit run through. Have you got any questions before I finish? No? I'll be around if anyone has. Thank you.